Welcome back, all. Tech Tune-Up at you once again. I'm your host, Paul Meeks. Today is July 15, 2025. We got a great show today. You will have me for the half hour, no guests, and we will have no guests next week either. And the reason I bring that up is next week I will be in the Motor City at Benzinga's headquarters to do the show there live. Do this at least once a year. I'm actually from Michigan, so I come out in the summertime and see some family. But I really love the regeneration, the metamorphosis of downtown Detroit. So I love being there. So let's get right after it. First of all, let's talk about the news items because there have been some really significant items. Not just this past week, but this morning. We're going to get to all of them. So first of all, Meta has made a very big splash and a huge commitment to putting the world on our glasses. They have taken, and they've spent $3.5 billion to do so, a 3% stake in Luxottica, the glasses maker. So when Meta gets that ball rolling, it's probably going to be a success. And I think this is very interesting because we've all, me included, have poo-pooed virtual reality glasses for some time. So maybe they now finally gain traction. Next to Apple, in the last week, their chief operating officer, Jeff Williams, says he retired, but my sense is he was forced to retire. And I don't feel bad for him because he's been at Apple so long and so senior that he's got to be worth at least several $100 million. But this does tell you something. We know that Apple has not grown its iPhone units for several years. We know that putting AI on their iPhones, which was supposed to be a huge driver of unit demand, at least as of yet, has not happened. And so the company is not just in a low growth mode, but a no growth mode without any revenue reacceleration in sights. And then to make matters worse, during Trump 2.0, now their perfect, absolutely perfect Chinese driven supply chain has been blown up. And so no revenue growth, and they will have much higher costs as they break up this supply chain and move manufacturing to higher cost places, including right here in the US. So we'll see. Next up is Supermicro, a company that I follow very closely. I used to like it quite a while ago, had been a good one for me. These guys make servers that go into AI data centers, and they just announced that they're going to get very aggressive with building up their manufacturing capacity for sales into Europe. We'll see what happens here. If you want to invest in that space, I almost always default to Dell. The problem with Supermicro is they have this guy who is their founder and CEO. His name is Charles Liang. And not once, but twice, even though he kicked the can down the road to his CFO at the time, he has essentially been busted for financial accounting fraud. So I don't trust the guy. And it deserves to trade at a huge discount because if they want to close that discount valuation gap with the likes of Hewlett Packard Enterprises and Dell, Charles Liang will probably have to fire himself. And if he's interested in increasing his wealth further, probably should. So the next on the list, Micron is interesting to me. I reported on their quarter last week. Since then, their stock has come in quite a bit. It's getting really interesting to me. I think the only flaw is that the stock had run up so much into the report, it was a little bit of letting some air out of the balloon. But I will tell you this, I'm looking to buy some Micron. There was a sell-side report yesterday predicting, and I don't agree with this, and I don't know how they have the evidence to say this, that their business at Micron is going to slow drastically in the second half of this fiscal year. Don't think so. In the meantime, I will tell you this, their CFO at $125 a share, filed to sell $20 million in stock. So you definitely don't buy it beyond 125 because their CFO, who knows more about the company's financials than you, will be selling it to you. But if it gets on a significant enough dip to give me at least a little bit of leeway before the 125, least near-term target price, then I'll do it. And I will do it. And I will tell you when I do it. But that's Micron. I think it's interesting what has come out of the European Union. Remember, one of my problems, if you followed my show over the years, is that I'm really bummed out, whether it was the internet era or now in the AI era, that the legislation that rules the world in these key technology paradigms does not come from the US. It comes from Europe. For example, we are still running the internet business in the United States based on legislation from 1996. Unbelievable. But in Europe, they now have published their artificial intelligence code of practice for compliance of companies that do business there. Again, I think it's probably good to have some structure because this is the wild, wild west, but why can't we just do it ourselves? That kind of pisses me off. Next, I have been talking a lot about CoreWeave and Core Scientific. We have a very big arbitrage spread between the acquirer and the acquired. Right now, based on the fixed ratio means it doesn't change, for the stock swap, which is supposed to happen by December 31 of this year, you would be buying Core Scientific for $17 a share, but Core Scientific is only trading for $14. So there's almost a 30% arbitrage gap here. So that's telling you a couple things. One, the deal won't happen. And two, people don't believe that CoreWeave stock will be higher than $100 a share. That's where we get to break even on this ARB spread at the end of this year. Right now, the stock's trading at about 150. So we'll see what happens. I think it'll be very interesting. The company announces their earnings in a week or two. I will keep you up to date. But I also skipped over something here. I think there is a big deal that has happened in fintech. A company called iCapital, they just did a money raise that values their company at about $8 billion. That's a big valuation. And just so you know, iCapital is a tech platform. And their claim to fame is allowing financial advisors and other intermediaries to put their clients in private investments like private equity. But when you see a fintech platform deal with an $8 billion valuation based on their latest money raise, it tells you that segment of technology, fintech, is back. Next on to Amazon. I think this is very interesting, and it could be a threat to the AI data server companies like SMCI, like Dell, like Hewlett-Packard Enterprise. Amazon has developed with its own engineering force something called a in-row heat exchanger. What does that mean in English? It essentially allows, when you build out data centers, to avoid the massive spending on liquid-cooled systems. If they can skip liquid-cooled systems, which are the technology of choice from all your key AI server companies, that would be bad for that group and very good for Amazon. So remember, you heard it here first, in-row heat exchangers. Say that 2 times fast. So we have a couple of companies that are reporting this week. We're not going to get the full brunt of my covered companies' tech reports until next week and even the week after, and even as we bleed into the first week or so of August. But this week, we do have a couple of major players. First, you have the Dutch company, ASM Lithography. Semiconductor capital equipment company, dominates the technology, which is oh so important for the industry, called EUV, extreme ultraviolet. We'll see what they have to say. We also have Taiwan Semiconductor, long on the Meeks buy list, long one of my favorites, but there will be no surprise when they report. It'll be an upside surprise. The only thing we're waiting for is some clarification on guidance for the next quarter, because Taiwan Semi is quite unique for a large cap tech company, that it actually publicizes its sales on a monthly basis. So we already know what the sales are. And then we have Netflix. Netflix is a stock that's had a huge gain for us. Super proud of it, in it for a long time. However, the stock is pricey. And I think that they'll beat the number. I think they'll make everybody feel good about their prospects. However, stock has come pretty far, pretty fast. I'm just waiting to hear what they say. So I don't own any ASM. Taiwan Semiconductor, I would buy even before the quarter report. And Netflix, I plan to just continue to hold it almost no matter what they say on the conference call this week. We'll see. Next, I think this is really interesting. OpenAI has announced that they are going to create and promote their own web browser that is going to directly compete against Google Chrome. This is, I think, an incrementally positive announcement for OpenAI, but it doesn't really fit into my OpenAI thesis. And remember, you can't invest in it yet because it's a private company. But this could be a real threat long-term to Alphabet, aka Google. This could cause, and they've already lost some browser market share, this could really dent that share. And of course, it's going to dent their big revenue driver, which is digital advertising sales. So we'll see what happens. And the key will be, how does Alphabet respond? How does it respond to the existential AI threat? We'll see. It's going to require some vision and some great execution. Next up is Meta. Meta has said, no surprise to me, $29 billion they will spend in the USA on data centers. The reason it's no surprise, they've already put out a monster budget for this year for capital expenditures, much bigger than that. But what is super interesting, and this may be a new paradigm for Silicon Valley, even though they have a powerhouse balance sheet and plenty of cash to spend, even though they generate free cash flow to such an extent that they don't even know how to spend it, they are, for this particular expenditure, going to raise money in the private credit market. I think that is super interesting. If we continue to build out AI infrastructure and then quantum computing infrastructure after it, but now you have tech companies that are going in cahoots with these private lenders. Think of them as the big private equity and private credit firms. Very, very interesting. Next up is our buddies over at Alphabet, aka Google. They are buying Windsurf. Windsurf has developed AI coding. Now, they're not buying the entire company. They're buying the bulk of it. But even the bulk of it is costing Alphabet $2.4 billion. And what are they doing? They just want to hire the best and brightest AI engineers. And think about this nuclear arms race. We've heard that Meta, which I think is probably bullshit, is going to pay people $100 million to bring their cred to Meta's AI development. Here's a situation where Alphabet is spending $2.4 billion to pick up some talent. That $2.4 billion isn't for all of Windsurf. It's for a part of it. We call this a acqui-hire, right? You essentially do an acquisition to hire the talent. And when you do that, you may be able to skirt the regulations for antitrust if you were to do a formal acquisition. Anyway, remember the term acqui-hire, the combination of an acquisition and obviously a crazy, crazy, crazy hiring spree. So next we have Synopsys. Synopsys just got approval, and I think it was the last approval that they needed from China to be able to go ahead with its $35 billion acquisition of Ansys. Now, Synopsys is one of the leaders with Cadence Design Systems. The ticker of that stock is CDNS. Synopsys is SNPS, and EDA software, electronic design automation software. So they're essentially a software platform and software tools for folks at the semiconductor companies to design their chips. I like the space very much, but I would much rather see you buy Cadence Design Systems. Why? They're essentially oligopolists. There is really no difference between the two. But I want the company that is not doing a major acquisition, so it has no acquisition assimilation risk, whereas Synopsys has a market cap of about $85 billion right now. And if they go through, as it looks like they will, with the Ansys purchase, they're paying $35 billion for that entity. So they're buying a company that's almost half their market cap. That ain't going to be easy to put together. So we'll see there. Next, take a look at Nvidia. Nvidia is the news of the day. Super important. Nvidia announced today that the US government is going to allow them to start or restart shipments of their H20 GPUs to China. Why is that significant? This quarter, Nvidia, without these sales, is supposed to do about $46 billion in revenue. If they had, at the beginning of the quarter, the wherewithal to ship those H20s to China, you could add another $8 billion to this quarter's revenue. So think about it going forward. Wall Street is going to have to take a look at their revenue models and probably add $8 billion or more to every quarter. And so, yes, revenue estimates are going to go way up. And if they hold their profit margin, which I think they will do for at least the next year or two, profit margins will continue to be at least flat. And this year or this quarter, they're supposed to earn $1 EPS. You probably add, another 20 cents to that just by resuming these shipments. That is the biggest news in tech. And the last thing in this section, one of the things that pisses me off is that Robinhood and AppLovin, two companies that we own, actually AppLovin is my favorite idea right here on the Meeks Tech list. They have not once, not twice, but several times, both of those companies have been passed over by Standard & Poor's to be added to the S&P 500 index. What the hell? It's bullshit. Here's why. Today, the entrant was Trade Desk, TTD. Trade Desk has $37 billion market cap. Robinhood has an $88 billion market cap. And AppLovin has a $120 billion market cap. How can you put the Trade Desk on the S&P 500 ahead of those two much bigger companies? I just don't get it, and it pisses me off. Somebody is in cahoots with somebody else, and it ain't good. And take a look at the Trade Desk today. It's up big on the news. I want Robinhood and AppLovin to be up big on the news when they finally get their asses into the S&P 500. So let's move on to my tech picks. Not many changes here. I've taken a couple of stocks from my starting roster and have them waiting in the wings, not typically due to valuation, or sorry, not due to fundamentals, but valuation. Been spot on the fundamentals on this program. But I will tell you that as you go through the list, there is one stock that I'm adding right to the green patch, which is my buy list. The yellows are the holds. It's a company called Nebius. It is a Dutch company, ticker symbol NBIS. And think of this as the European CoreWave. They have a cloud platform to host AI applications. Very much what the business model is of CoreWeave, which has been a very successful IPO. It came public at $40 a share in March, and now we're pressing a four-bagger. Even though both CoreWeave and Nebius are not making any money. They have very clear revenue growth trajectory. And the nice thing about Nebius is its story is not clouded, as CoreWeave's story is, by CoreWeave's proposed acquisition of Core Scientific. And remember, I told you about that big ARB spread. So out of all the companies that I have in green, which I like to say are my fresh money buys, that is this week's new one. So let's move on to tech trends. You know, I am a Fed watcher, and I watch this very carefully because I've said a million times on this segment, tech and other aggressive growth stocks cannot go up consistently and strongly unless you have flat to declining interest rates. We call that the beauty of discounted cash flow valuation modeling. So it looks like the Fed will do nothing when they next meet, and it looks like they are going to lower the benchmark interest rate, in which all other interest rates are built in this country, by about 0.25%, but they're going to do that on September 17th. Looks like they're going to take the next meeting, and they meet every 6 weeks, off, almost regardless of how much blasting Chairman Jay Powell takes from the President of these United States. So we'll see. If I was Jay Powell, I would do the same thing, because even though the numbers are neutral to maybe supportive of lowering rates, we have not seen the full impact of the tariffs. And if the tariffs are inflationary, you gotta see that play out, don't you? And of course, we had tariffs that were going to go into effect on July 9th, and now most of them will go into effect not until August 1. So stay tuned for that. I want to reiterate the concept that I just told you about, because it's all the rage in Silicon Valley. Remember my acqui-hires. Instead of doing a formal acquisition to pick up some interesting talent, to pick up interesting technology, a large technology company in the States will not formally buy the company, because when you formally buy the company, you set yourself up for deal scrutiny. But you essentially pull out of that company all of their talent, and essentially you've had a de facto acquisition, and you've gotten around the regulators. And we're seeing this, right, with Alphabet, with their $2.4 billion lift out of the talent and intellectual property of the AI software coder Windsurf. So next, the other thing I want to tell you is, here is a term. This is the education settlement. It's called a 10b5-1 plan. When a company's directors or management or other insiders sell stock, they like to tell you, to give you some comfort, that, oh, I was told by my financial advisor to diversify, and this is all part of a 10b5-1 plan. I will tell you this, that yes, the CFO of Micron the other day initiated a $20 million program when the stock was trading at $125 a share. Even though it's now on autopilot, it really isn't on autopilot. When you create one of these plans with whomever you create it with on the Wall Street, you do put different terms. And one of the terms that you probably are entering into the plan is, I don't care what happens, but this is my sell target. And so no matter what bullshit somebody spends about, oh man, it wasn't my sale, it's a 10b5-1 plan. Well, you know what? Even these plans that are supposedly on autopilot, they have very strict terms as to when they sell shares. And the CFO of Micron is telling you at $125 a share. So remember, don't get lured into the bullshit of the autopilot of the 10b5-1 plan, because it is used by most executives at all the leading companies in Silicon Valley. The last thing, and this pertains to the Fed's decision whether or not to lower interest rates, the consumer price index came out today. And I look at the core CPI, which excludes the volatile food and energy. But on a year-to-year basis, it increased 2.9%. That was about what Wall Street was expecting, even though I did see a couple of estimates out there for 3.0%. And then on a month-to-month basis, this would have been from May to June, it increased 0.2%, probably a little bit light. So I will tell you this is very interesting. We're kind of stuck in this 2% plus range for inflation, but it's very manageable. And do we ever get to the Fed's target of 2.0% flat? I don't even know if that's doable in any economic condition. But I will tell you this, I still think the Fed's doing the right thing to kick the can down the road to their September meeting, because tariffs are inflationary and we haven't seen the impact yet. If I'm Jay Powell and I'm the other 11 members of the FOMC, the Federal Open Market Committee that decides on rates, remember the chairman only has one vote out of the 12. I would wait to see if and when these tariffs have an inflationary impact. So with that, that's all we have today. If you have any questions, I can hang for a minute. Happy to answer some. If you don't, pretty easily found. Okay, so I have a question here. Thoughts on Alibaba? Among all of the major Chinese tech companies, Alibaba is my favorite. I do think that this relationship they have with Apple could be quite important. But I would tell you that if I had my preference, I'd still probably go with the domestic names, particularly the AI infrastructure names on my list. But I know I've had Alibaba on the list. If you bought it based on my recommendation, you know what? I think it'd be cool. I would just continue to hold it. But if you were thinking about buying it fresh today, I have better or bigger fish to fry. Does the S&P 500 decision for the inclusion happen at pre-announced dates? I know it happens quarterly, but the trade desk decision didn't fall on one of those dates. You know, I do think that there's at least some semblance of a schedule, whether it be quarterly, semi-annually, or annually. But yes, they have in the past and will continue over at Standard & Poor's have some, I don't know if I want to call them surprises, but some off-schedule picks. And again, as I said before, I'm kind of pissed off. Why the trade desk before Robinhood and particularly AppLovin? AppLovin is 4x the market cap. And isn't this supposed to be a market cap weighted index, the S&P 500? But anyway, I was a little bit surprised when I read the announcement. So I'll tell you, I wasn't expecting it. So stay tuned. Let's get our two boys somehow into that index. Thoughts on APLD? You know what? I'll probably pass on that. I will come back to you on the next show. I obviously know the company, but I haven't looked at it for about 2 weeks. I don't want to give you any stale data. So anyway, I'll be back with you next week, promise. Thoughts on Apple? I do not like Apple, and I haven't liked it for years. Not to say I don't own any, right? I've been a tech investor since the 80s. And so I have clients that own it, and I don't sell it because it's got such a scary low cost basis. But among the Mag 7, and now there are some leadership tech companies here and abroad that even might eclipse the Mag 7, I don't have Apple there. As I said before, no revenue growth, and their key revenue driver was supposed to be putting AI on iPhones. The bull analysts a year ago were saying, even for this past Christmas, which didn't happen, that was going to lead to, quote unquote, the mother of all iPhone upgrade cycles. Didn't happen. I actually think for a lot of these consumer electronics vendors that AI will end up being a feature. It won't be a standalone product. It'll be a feature. Just like when we started putting cameras on iPhones. Everybody's got it. It's cool. You know, maybe it's something you absolutely have to have. I don't know if it's going to drive sufficient upgrade volume. And then again, under Trump 2.0, not only do you have flat revenues, but now you're going to have much higher expenses as they try to replicate this Chinese supply chain in the United States. So I think they're being squeezed revenue. I think they're being squeezed expenses, and that leads to the ultimate profit squeeze. So I would stay away from it. If you own it, there's always going to be people that are fanboys and they're going to buy this stock on dips. I haven't sold any of my shares, but I have a cost basis that's just ridiculously low. Better opportunities today than Apple, in my view. With unresolved tariff issues, tells you how old I am when you see me squinting into the camera. With unresolved tariff issues, the market was quick to rebound. Do you think we can expect a similar downturn again? You know what? That's an excellent question. I think that we will have a downturn later this year, but I don't think it's going to be as deep, and I don't think it's going to last as long. And to put this in perspective, in only 4 days after Liberation Day on April 2nd, the S&P 500 went down about 12 or 13%. From top to bottom, from its top in February to its bottom after the Liberation Day announcement in April, the NASDAQ had a full-blown bear market. It was down precisely 20%. So I think what happens is maybe some more consternation about geopolitics gives us another correction, but I don't think it's going to be that steep. And I think it's going to be not even that long. I think we'll snap back even quickly. So what does that tell you? If you're a long-term investor, you want to buy the dip. All right, guys. Well, there's one more here. What do you think are the best stocks for supply data centers with power, cooling, integration, or other aspects related to them? Well, the obvious one today is not necessarily a play on data center power, but on its access, which is necessary to run those data centers with MP and the deal that it signed for $500 million with Apple to essentially create and promote rare earth materials here in the States. I think that's a better play. So not necessarily a direct, maybe an indirect power play, but I still think over time, Vistra, Constellation Energy Group would be good stocks to own. They're kind of expensive now, so I buy them on dips. All right, guys. Next week, you will see me from the Motor City, Detroit, Michigan, at Benzinga's headquarters. And I look forward, and remember, I will follow up on that one question I didn't answer today. All right, have a good week.